Hey folks, David Frost, My Strategic Forecast, and today I have something a little bit different for you, a little bit off the beaten track. I want to talk about the bond market, and it doesn't sound sexy, and the bond market's not sexy, but rest assured I'm going to tie it right back into the stock market, and I think what I'm about to discuss is going to be fascinating, and I think you'll understand as this video goes on why I'm bringing this up, why I'm looking at it, and why it ties back into the stock market, what we can expect going forward, and more importantly, how to make money with all this stuff. And that's what I do for my members. I look at stuff that most people don't even consider, but yet I'm able to tie it back and teach my members how they can make money using the information that I put out to them each and every day. So what I'm going to do is we're going to take a look first at the long-term 30-year bond rate. This is the interest rate. And the reason why I want to look at a long-term rate is I just want to show you over the last 15 years what's happened. From the year 2000, the rate hit a high of about 6.7% on the 30-year bond, right? The 30-year interest rate, 6.7%, way up here, okay? And we've been downtrending ever since. And we've been downtrending not necessarily at such a rapid pace, other than the couple of dips we took when the Fed stepped in and had their QE programs, but for the most part it's been a pretty significant downtrend all the way through and through. But that's not what's important. I want to show you something fascinating, and here's where I'm going to start tying it into the bigger picture, the stock market, and how we can make money using this information. Look at this chart I found. This is the long-term interest rate back to 1790. I don't know if anybody was around in 1790. I certainly wasn't. But yet again, I find this fascinating, and let's just go through some of the nuances, and then I'm going to give you the meat on the bone. I'm going to give you the sizzle and the steak with this stuff. So just to kind of recap on where we were, way back in 1790, we were about a 6.5% rate. Rates spiked up into 1798 up to 10%. Back down, and this chart gives you some areas and information on using some cause and effect things. I think they want you to believe that certain issues like a Mexican war caused rates to spike up and a civil war caused rates to spike down. That's not necessarily the case. They're just depicting the point in time that civilization, if you will, was in at those times. And they're just pointing out that around the Civil War in 1860 to 1865, here's where rates were. Here's where gold was at the time, and gold crashed in 1869. Rates, long-term rate, happened to be over 8%. Panic, and this was a stock market panic of 1907. Rates went all the way down to 3.7%. Okay, World War I, here's where rates were. World War II, they were at an all-time low in 1946 at 2%, and so on. We had a huge spike up into 1981 in and around the Iran hostage crisis and the oil embargo, and that was over 14%. And if you will remember, mortgage rates were even higher than that because this was the long-term interest rate, but this was the rate that the stated rate was. If the bank wanted to lend you money, they needed to make a spread, so they were actually charging you and I a higher rate than 14%. We were paying 17% on a 30-year interest rate mortgage, for example. And then from that point forward, and here's where it gets interesting, rates from 1981 came all the way back down, and there's literally dozens of reasons why rates came all the way down from then, beginning when Volcker wanted to put the spear in the head of inflation, and he raised interest rates all the way up to stave off inflation. Rates came all the way back down into 2008 at about 2.87%. And this chart's a couple of years old, but guess what? The rate is exactly the same today. The 30-year rate is 2.89 as I make this video now, so they're about the same. And here's where we are. And here's where it gets interesting. This is what I want to point out. Okay, you see throughout history, this is over 225 years, rates have gone up, they've gone down, they've gone up, they've gone down, they've had super spikes, and they've had really, really low rates over time. But here's the important thing, and my members know that I utilize Fibonacci numbers, not only for the numerical value of what stocks or bonds or any other market that I'm analyzing for them may be, and may get to in terms of support and resistance levels, but I also use Fibonacci as it relates to time. And I tell my members over and over again that time is much more important than price. Why is that? It's because time gives us an indication of when a market should make an important turn, and when we know when a market should make an important turn, we can subsequently figure out what that price should be. And when we put those two things together, that's what allows us to make big profits in the markets, whether it's the bond market, the stock market, the crude oil market, the gold markets, or any other market. It doesn't really matter. All charts are the same. All markets are the same. They all react to important points in time and price. And when I use Fibonacci in time, this is what I want to point out. 1981, if you go back in time from 1981, one of the very most important Fibonacci numbers that we know of is the number 34. And if you take 34 away from 1981, you get 1947. And as you can see here in this chart, 1946, just 1 year off, was when interest rates were at a low. 34 years later, they were at a high in 1981. If you fast forward 34 years from 1981, where are we? 2015. And that's one of the compelling things that I wanted to get the point across. Think about where we are. 34 years, an extremely, extremely important Fibonacci number. And we're at that point now. And what are we hearing now? The Fed wants to raise interest rates. China's holding a lot of our treasury bonds that they're beginning to sell into the market. And when bonds get sold into the market, it puts downward pressure on the price of bonds. And what happens to the price of yields or interest rates? They go higher. Bond prices go lower, yields go higher. Who else owns our bonds? Japan owns our bonds. Both China and Japan together own roughly 15% of the total of our outstanding treasury bonds. 35% of our treasury bonds are owned by foreign countries. Another one is Brazil, and if anybody's paying attention to Brazil, they're going through their own economic crisis right now. What do you think they're going to have to do to raise money? Do you think they may have to sell some treasury bonds to raise some cash? They own around $200 or $250 billion worth of treasury bonds. Our own Fed owns treasury bonds. Banks own treasury bonds. So other countries in Europe and other countries around the world own treasury bonds. So what do you think will happen when those countries begin selling, or some already have begun selling, treasury bonds into the market? Well, it's going to push up the price of yields. Now understand, the Fed raising the short-term interest rate has nothing to do with this chart here. It has nothing to do with the long-term interest rate. It has to do with the short-term interest rate. But the countries that own our treasury bonds have everything to do with the long-term, interest rate. So if the long-term interest rate raises, and here's where the sizzle comes in, because here's where we tie it into the stock market. When the long-term interest rate goes up from 2.8% or 2.9% to 4% to 5% to 6%, that puts a crimp in the economy. Why? Because companies have a difficult time rolling over their debt, refinancing debt. It costs more. When it costs more for companies to borrow, it puts pressure on their stock price because their earnings go down. When you and I try and borrow for a mortgage, we're having to borrow at higher rates. We're able to buy less of a house. Interest rates on everything we know about goes higher. Therefore, if everything costs more, we can buy less. If we buy less, then the cost of everything has to come down because it's supply and demand, right? It's called elasticity, price elasticity. If we begin to buy less, companies lower prices so that we buy more. When they lower prices, their earnings go down. When their earnings go down, their stock prices go down along with it. So you see, there is a direct impact on higher interest rates and stock prices, and as a whole, the stock market. And as you can see, here we are right now in the September timeframe of 2015. We're starting to see the market crack. We're starting to see interest rates start to creep up a little bit. Bond prices start to come down. And I'm going to show you one last chart that you should find interesting. Now, this just happens to be a weekly chart of the 30-year U.S. Treasury bond, the opposite of the yield. This is the actual Treasury bond price. Okay, and as you can see, here was basically an all-time high, and now, and my members are fully aware of how this works, we've made a high in the beginning of 2015, we made a lower high a few months later, and now we may have made a lower high once again, and also this red candle here is known as a reversal candle, okay, and my members understand what the ramifications is of that. But my point is if we see Treasury bond prices begin to come down, we're going to see yields rise, and that has the cascading effect on the stock market, and that's why I wanted to tie those two things together. A lot of people are a little bit confused on whether this is just a stock market correction or whether this is another bear market starting, and I just wanted to point out some things from a longer term perspective. And I want to go back one more time to this long-term bond chart. And once again, if we use Fibonacci, and Fibonacci in terms of time has what we call Fibonacci retracements. And a lot of times a market will retrace a certain amount from a prior move. So for example, if this is deemed a low, for example, and we retraced from high to low, even a third of the number, okay, that puts us at around 7 or 7.5% interest rates from where we are today. And it's my belief that if interest rates went from, the long-term interest rate went from 3% to 7%, which is well over 100% increase in percentage terms from where we are now, I think that could have a devastating impact on our entire economy, not just the U.S. economy, but it can also have an effect on the economy around the world because a lot of our corporations are global in nature. So these are the things from a longer term perspective that you want to understand, and I teach these kind of things to my members on an ongoing basis, and I tie them into what's happening today in the stock market and where price discovery can be found in the stock market, and whether we're on an upswing or a downswing in the stock market on a short-term basis, which allows them to either be long or short the stock market or stocks or bonds or gold or oil. And these are the things that I do for my members each and every day. And you're welcome to come check out my service, My Strategic Forecast. You're welcome to a 14-day free trial. You get these videos that I put out each and every day. They're usually between 20 and 30 minutes long. They give you an exact depiction of where the markets are, the stock market, the bond market, gold, oil, and others on a daily basis, and what I think the next direction is going to be and how you can profit from them. So it's very, very important. Come on and check it out. A 14-day free trial. You have nothing to lose. MyStrategicForecast.com. I'm David Frost. Thanks for tuning in. This was another lesson of the long-term interest rates and bond market. Thanks, folks.